why am I talking about this? I haven't even touched Andrea's question yet. If the underlying stock shoots up, when do you suggest to close the underlying to secure the profit? Let's go back in time to NVIDIA. I'm just going to go back 2 to 3 weeks, Andrea. Okay? I'm going to go to the chain. And we're going to go, when you're on the trial, you have access to sort of 2 or 3 weeks of historical data. So 3 weeks, let's go back a full month. We're going to go to July 8th-ish. Yeah, there we go. We're going to go back to July 8th. We're at 182.70 right now. NVIDIA was at 160. And in our default search, we saw a NVIDIA opportunity. It was 196 days out in time with a limited risk of 8.8%. That was in February. We're going to go to January. So if on July 8th, we bought NVIDIA even at 160 and 192 days out, I'm sorry, I just want to look at the puts, folks. Let's change that on the historical chain as well. We saw a price of around $20. So I'm going to go with for an 8.8% risk, I'm going to go with the 165. Remember, this was on July 8th. We're going to take the 165 put with a midpoint price of 1980. Very viable. 1975 to 1985. Yeah, 1980. Very, very reasonable. My time value percentage I don't have here. Oh, there it is. Midpoint time value is 9.3%. I'm sorry, I wouldn't have taken that one. We're going to keep it even. We saw the 8.8%. Volatility was a little bit higher last month. 2090. And again, 167 strike, reasonable midpoint. There was options activity, current option volume, and open interest. 2085 bid, 2095 ask. Yeah, we're going to get 2090 for that. Perfect. All right. So buying the stock, 160, buying our 167, my apologies, Jan put with about an 8.7% risk. Let's go to the portfolio. And I'm going to go into setup first, and we're just going to call this the August 8th portfolio. Now, I'm going to simulate that I started this. Well, we're buying at least 100 shares at 160, so we've got to have at least $16,000 there. Let's just put in 20,000. And I'm going to copy that over, and we're going to change our date to July 8th. Let's go ahead and save all changes. Now, once I've created that portfolio, I'll click the main portfolio tab. Let's enter our new strategy. We're going to click on select strategy to enter our new position. Drift down to Married Put here. Entry, same as you'd have on your broker. What is my stock? NVDA. Number of shares, 100. With our price of 160. And transaction date, July 8th. Let's just keep it honest. And what did we do? We bought the January. Let's go to view options. Sorry about that, folks. I'm going to open that up a little bit. It's not going to let me here. I'm trying to get the arrows. Okay. But the January one that was 192 days out in time, we were at the 167 put. There we go. And we bought it again on July 8th at the close. Not a real trade. And we had 2090 as our price. Now you see it's priced at 1110 right now. It's not at 0, even though the stock has moved up. There's still time value in that position. Let's go ahead and submit that. See where our Married Put is right now. Oh, I want to go to the stock analysis view. Anytime you're in a spread, folks, multi-leg transaction, I encourage you to use the stock analysis view. It gives you a breakdown. So we're up 14.2% on the stock, or 2270, and we've lost only what? 985 on the stock. We're making more than 65% on the gain in the stock, even with that expensive, what you might call an expensive put in place. Now the stock is up 14.2. Yeah, we're at 50% gain, 7.1%. That's our current liquidation loss. That's why I like the stock analysis view. It gives us these extra 6 columns here that you see on the right. So I can see my original position cost and my original expected gain. Well, this is a Married Put. Unlimited upside gain. It doesn't have an NA, but if you had a covered call or cash secured naked put, you'd see the original expected gain or loss and could compare it now to where you are if you liquidate the position. And the future expiration gain or loss is saying what? It's saying that if I hold NVIDIA all the way to January expiration and the stock remains at 182.70, I'm only going to make 1%. Why? because I'm going to lose this $11 of time value that still remains right now. So we've got a 2270 spike on a 160 stock. Not a huge move, Andrea, but it's in a 31-day time period. That is important. The three core principles discussed in the blueprint as to why we're using this far out in time put in the money, talking about the three core principles of radioactive trading, the at-the-money bell curve. When you buy an option, you want to be buying on the wings. You want to be buying in the money or out of the money to be paying into the lower time premium. With a married put, we want to be buying slightly in the money because that gives us that controlled single-digit risk that we saw of 8.7%. It avoids the fear of gambler's ruin. The time decay curve, which you're seeing here. So this is 240 days out in time. This is 220 days. This is 200 and so forth. Right here, this drop is right about 100. It's a little bit more. It's like 120. And then here is about 90. And here is about 60 days remaining to expiration. It's a little bit steeper than I should have drawn. It should be coming out like this. Then there's 30. Then there's 10. Then there's 5. All right. So the idea is the time decay here in these further out options is much more gradual. And then it starts to accelerate as you get closer to expiration. We're still 161 days away. This $11 that's all time premium, if NVIDIA is just bouncing up $1 or $2, that's going to maintain. And then, of course, forcing an ideal size trade, risking only a small percentage, 8.7% as we saw in the initial profit and loss chart, but I'd make sure this is only about 2% of my total portfolio, the monetary initial at risk that we saw for the NVIDIA position that we just entered here. Let's take a look at what it was. Yeah, profit and loss chart. Oh, it's 7.7%. My apologies. So this here is the worst case scenario, as I mentioned, but it's $1,390. And I make sure that $1,390, that's going to dictate how many shares I buy. Those are the three core principles. But again, what now? We've got a big gap in the stock. It's up 14%. Let's say it happened suddenly, Andrea. Let's say it's happened over time. We're 30 days into the position. Directly to your question, what do you suggest to do to close the underlying to secure the profit if the underlying shoots up? And conversely, when should you close the protective put if it's losing? Okay. I'm not closing in this scenario, Andrea. I got into this position with the goal of I bought the put that was 192 days out in time because I'm planning on holding this for at least 4 or 5 months. When I open a married put position, this is discussed in the blueprint, of course, in the first introductory chapters. When I buy a married put, my expectation is the stock is going to move up 3 to 6% in the first 20 to 40 days, with the expectation that further it has the opportunity to move up 6 to 10% in the following 60 to 90 days after that. So we're looking at a 16, 17% gain in the stock using the income methods to enhance that. That's why I open a married put. Also, why am I using this in my portfolio? Well, the protection is awesome. You've heard me talk about that. It's probably saved you, Andrea, in different scenarios from our conversations as well. The conversation I had that I'm going to jump into in a minute from the coaching session was the married put saved the structure that he was in, saved the position on the downdraft that he took. But at the same time, he played it a little bit wrong. So this scenario, my stock is up. It's not big. It's not one of those 20, 30% moves that we saw in some of the stock movements today with trade desk 30% down. We might even use that as an example, but here we are. And underlying stock shoots up. Do I close the underlying to secure the profit? No. In this case, I've been in this for 31 days. What I'm doing in this case is income method number 4. My stock's now at 182.70. I would have done it before, Andrea, as you know. I haven't done any adjustments on this position yet. What I'm most likely doing with this married put, if it was real, from July 8th, 2025, we saw the historical prices closed at 160 even, could have bought the January 167 put for 2090, risk of 7.7%. We're at 50% profit of the underlying move exactly. The stock's moved up 14.2%. We gave up some of that for the put option. We're at a 7.1 liquidation in 31 days. That's important. But I'm planning on staying in this longer. I think there's further upside. I would have made that decision when I entered this married put. What's my second working asset? Is the put at 0? No, we saw that when we entered the trade. It's still at 11.10. So what I'm going to do in this case is I could do multiple things, but we're going to keep it easy. And I'm just going to talk about income method number 4. One of the 4 ways to manipulate the put option in your favor. Oh, wow, NVIDIA, you're all over the place. All right, so there's my 167. To simulate this adjustment, Andrea, I'm going to click it again. Although it says added, I clicked it again. Now remember, our original cost base on the stock was 160, 20.90 for the put. We had a total cost of 180.90 into the position with a guaranteed exit of 167, 7.7% at risk. I'm going to sell our 167 put now. So when I clicked it again, it put it back in. I'm going to sell that, and what's that going to do? That's going to drop our cost basis. So right now we're just looking at a long stock position. The profit and loss chart is not reading that I actually closed the put, but the mathematics are correct. You do this with rolling a covered call, simulating rolling a cash secured naked put, credit spread, anything along those lines. So essentially now I own shares of stock at 169.85 per share, right? Because I lost on this put. The put declined. We had a 7.7% risk. I sell to close this put. I have an increased cost basis, not as much profit, but I still have risk of 100%. My stock's at 182.70. I'm going to stay in January. Simple income method number 4 adjustment. Sorry for the scrolling, folks, with the NVIDIA ones. And I'm going to go up to the 190 put. Right now, maybe 189, but let's keep the math simple. Let's keep it at 190, 21.20 midpoint. Am I going to get that? Yeah, 21.15 bid, 21.25 ask. Absolutely. I'm going to roll up to the 190 put. Now, this is going to cost more. This is going to increase my cost basis significantly. Originally bought a put at 20.90, Andrea. Sold it for 11.05. So I lost $9.90, almost $10. And I'm paying another $21 into the position. My cost base is now up to 190.105. Andrea, what do I have? I have the 190 strike put. I'm now at 0.5% risk on the position. And my liquidation value is almost still the same. Let me explain that. Let's go back to our portfolio. Let's go back to stock analysis. Right now, my liquidation value is at a profit of $12.85. I want you to keep that in mind. $12.85 at 7.1% with stock up 14.2%. Now, I just added to my cost basis. I lost money on my initial put. I paid more money for this new put. Essentially, yeah, I paid $1,000, right? I paid $1,015 to do what? To move up my guaranteed protection 23 points. Where else can you find that guarantee? Now I can get out of NVIDIA at 190. Yes, I paid a premium of, once again, $1,015 to gain a higher payout of 2,300. That's guaranteed. That's not a stop order. That's not a trailing stop in case NVIDIA gaps down next week to 150 or 140. I paid in $1,000 to get $2,300 back. Positive $1,300. The risk dropped from 1,390, I think it was, down to 105. That's the power of income method number 4. Yes, I added more money into the position. What I don't want to do at this point, again, because of what I said, my CEGA model. When I open a married put, I'm following the CEGA model for the blueprint. And the CEGA model for my portfolio, and mine is different than Ernie's of what our goals are. When I open a new married put, what am I doing? What are the current conditions? Do I think we're in a good bullish status? Do I think there are certain sectors or industries right now that are primed to move? On July 8th, obviously, NVIDIA would have been. Expectations. What did I say? That I have the expectation the stock is going to move up 3 to 6% in the first 20 to 30 days. This is all talked about in the blueprint, with an additional maybe 6 to 10%, let's say, over the next 60 to 90 days. I'm going to plan to stay in it for that long. My goals, your goals are going to be different than mine, Andrea. My goals are to make 1.5% to 2% realized or unrealized return per month on my married put positions, whether via income methods or unrealized. Well, I've slaughtered that. We're at 7% unrealized right now. And of course, the A, there's the conditions, expectations, goals, A, that determines my actions. So the conditions met, my expectations for NVDA, my goals are to make this. I think it's going to achieve that with or without the income methods. That determines my action. I would have entered this married put on July 8th, 2025. With the income methods, it's the same thing, and it's discussed in each of the chapters in the blueprint. Why would I do income method number 4 right now? Because the current conditions are my stock is up, it's above my put strike price, I'm planning on staying in the position longer. My expectations, again, NVIDIA could still continue to grow, that 6 to 10% over the next 60 to 90 days, where I can continue to do income methods. Goals, to make that 1.5% to 2% per month, realized or unrealized using the income methods. Well, we're beyond that, and I just locked it in. My risk is now only 0.5% instead of 7.7%. Even if this gaps down, I could lose 0.5% where I'd have a profit right now. And I know that's your question. Should I start taking profits? Should I start doing this? We'll get to that in a moment. And then that determines the action. Well, in this case, I'm going to combine income methods, okay? Income method number 1, the most obvious, is what? Sell a call on the married put. What does the call do for you? Caps the upside gains, just like a covered call position. But now I've lowered my risk to 105. The stock's at 182.90. I've got a 190 put. I want to give myself some room. Am I going to sell the January call? No, I'm going to follow that 3 core principle. I'm going to sell near and buy dear. I'm going to go shorter term. I'm just going to use August 22nd. I'm going to give myself some breath. Not as much as I wanted. So we'll go with the 192.50 at 121. Now, doesn't give me as much room as I want. I may actually go with the 190. But let's go ahead and do this one here. What just happened? Let's keep it even instead of these weird midpoints. 120, very reasonable price for that call. Where am I at now? Bulletproof status, guaranteed a profit of $15, even if the stock collapses now down to 140, 120, 110. Return 9.9%, 2.8% higher if the stock's trading at 192.50 in the next 14 days. Now, let me clear that out for a moment. I want to step back. I'm sorry, I forgot to show something. Let me clear that out. Let's go back to our original income method number 4, paying roughly $11. I'm sorry, roughly $10 here, $1,000 to gain 23 guaranteed payout, almost near bulletproof status. I'm going to add this position, Andrea, to the portfolio. August 8th, insert. Stock. Oh, okay. Yeah, NVIDIA. There we go. Okay, so that's everything. I'm going to put it in as 8/8. Okay, even though we did it before, we're going to put it in as 8/8. So let's go ahead and submit that. Why? The date doesn't matter. Liquidation value right now in our position, our existing position. Before, Andrea, you said sell to close the stock. Keep the put open. Or before we did anything else, is $12.85 monetarily against a cost basis of $18.90. When I did this adjustment, the minute I do this adjustment, even though I added $1,000 to the cost basis, my liquidation monetarily is still the same. The percentage is a little bit lower, but it's still the exact same because the put doesn't go to zero. The call doesn't go to zero when I sell it. We haven't sold the call yet. My apologies. But that new put that I bought doesn't go to zero. The monetary return at this instant is exactly the same as where you were if you tried to pocket the stock profit and leave the put open thinking that it might pull back down and then you can buy back in at a cheaper price. In this scenario, stock pops up suddenly. I'm looking at income method number 4 because my trading plan for the married put in my portfolio was to stay in the position for at least 3, 4, possibly 5 months. That's why my put's out 190, 200 days, 210 days out in time to start. I could adjust later as well. Now the stock falls. Well, we just saw that with On when I talked about earlier. The stock is declining drastically, but I've managed to have it at a profit. And if I was in the position from the beginning, I would have used one of the other income methods to manipulate the put, income method number 9 or income method number 12, if I caught it right, to do that. Now, again, let's go back to the video very quickly. I showed an income method number 1 that would have bulletproofed the trade, would have taken it down to guaranteed profit or break even, 0.1% essentially, with a potential to increase the current return we saw of 7.7% up to 9.9%, a 2.8% gain for 14 days if the stock did move up to 192. All right. Something else I might consider, I'm going to go out 30 days in this case. I want the better premium. I want the higher numbers. 28 days, September 5th. Let's go, it's 42 days out. Let's go standard September expiration. And I'm going to stay with that 190 call where our put is. And why would I sell right at 190 if my expectation is going to move up higher? Because I'm going to sell the 190 at 705. I'm buying the 195 at 520. All right, so I'm going to take in 705. I'm going to buy a 195 higher strike call at 520. Now, those of you that are savvy, you can see what that is. Mike's selling a 190 call. He's buying a 195. He's entering a bear call credit spread. Well, if he's bullish on this stock, and he just bought the 190 put because he thinks the stock's going to continue to move up, why would you ever do a bear call credit spread, which works if the stock moves down? I mean, I'm collecting a net credit of $1.85, roughly. I think I'd math that wrong, $1.75. My apologies. But in the context of the married put position, this looks to your broker, and it looks on the graph as a covered call. You're selling the 190 call that's covered by your stock with a cost basis a little higher than 160 after we did the income method number 4 adjustment, and you're buying a higher strike call, which gives me infinite upside potential. Yeah, there's a little heartbeat there. There's that little bump between 190 and 195, where at this point I'm losing 1-to-1 delta at expiration if the stock's above 190 until it crosses 195. So I've entered a position here with a bulletproof status of 0.4%, $80. But that's if the stock collapses down to 144. You know, anywhere here at 160, we're at 510. We're at half the profit that we would take right now on the stock. Or liquidating the married put. Here at 170, it declined down. We're still at 800. We're at 66% of the profit we could take right now. If it's at 180, we're almost at the same value. $1,100 profit with this move. And this is on the near-term expiration from when we sold the bear call credit spread. And so on. And at 1517 here, $200 or $300 higher profit, not that much, 1643 at expiration. Little dip here, still above the maximum profit we have at 1285 we liquidated right now, and then onwards and upwards with no chance to lose on the position. And that's the worst case scenario. Again, we're talking about if we're down below 140. That's at September expiration in the next 42 days. That's the power of the income methods. Not giving up on the stock. I'm not trying to time my trades. Okay. I'm not saying, oh, I've got this big gap. My puts lost 50% or more. I've got a huge gain on the stock. I think the market's going to turn. Let me go ahead and sell the stock and leave the put open in this case. Okay. Well, let's just take a look at the chart for a minute. Yeah, we've got a negative MACD cross. I'll give you that. And it's been holding up here and it's been hanging up here. So that's discussed in the blueprint. There is an opportunity where you could say, hey, if I hit this and I see a negative MACD curve, let's not discuss this way, but if you think it's hit a top and you're going to have a decline, you could go ahead and sell the stock, leave the put open, and it comes down. I prefer to use the income methods to lock in the upward gain at this point, protect the position, get to bulletproof status, and then milk those income methods the rest of the way.